Good afternoon, everybody, and welcome to our lunchtime webinar on data analytics and audit. My name's Alex Peel. I'm a partner and head of audit and assurance at James Cooper Creston, and I'm joined today by my colleague James Pitt, who's also an audit partner with James Cooper Creston. Today we're going to look at data analytics as part of the audit process and look at what that is, and we're also going to have a look at some of the advantages of using data analytics. We'll also look at some key benefits to clients from using data analytics techniques, and we'll provide some examples of the sorts of things that it can do. At the end of the webinar, there will be time for some questions, so if you do have a question, there should be a facility on your screen to be able to ask a question, and if time permits, we'll cover as many as we can. Okay, so before we get going, I just thought it'd be useful to understand what people know about data analytics at the moment. And so we've got a couple of poll questions which we'll be using throughout the webinar. And the first one should be appearing on your screen shortly. And it's a nice, easy question to get us going. Does your auditor currently use data analytics as part of the audit process? So if hopefully that's showing on your screen, if you can quickly give an answer, and we can then move on with the webinar. So answers are coming in there. I think everybody's voted, so we'll close that poll, and that's an interesting answer actually. Most people, the vast majority of people, aren't actually sure. One thing, by the end of this webinar, I think the people who are not sure will know far more about it, so hopefully they can move into a different category. Okay, so what is data analytics? I'll talk in a minute a bit more about the traditional audit approach, but data analytics is a wide-ranging area really, and what we're talking about is looking at client data using analytics software, and we're using computer software to look for things like unusual activity, looking at the data for trends, for outliers, and sort of looking at risky transaction areas. And one of the key differences between the use of data analytics and other audit techniques is that with data analytics, you typically look at the whole data set. So instead of focusing on a number of transactions within the accounting records, data analytics will suck in the whole of the accounting records for the year and then look at all of it and analyze all of it. There are many data analytics, well, there are now several data analytics products on the market, and it is quite a new area for the audit marketplace, but they all provide a suite of different tools which can be used. Some of them are slightly different, and we'll talk in a minute about a package that we're using, but they're really a suite of tools that can be used as part of the audit process. So what are the advantages of data analytics then? I think I'd point out at this stage, and as I've mentioned, this is quite a new area, that it's possible to do an audit and for us to sign an audit report for a company or a charity or a school or any entity and completely comply with the auditing standards and rules without using data analytics techniques. There are a number of more traditional audit work areas which we use and many other audit firms use, which will enable that firm to comply with the relevant standards. So things like analytical procedures, where for example you might look at the 1 year and compare it with another year and understand the relationship between the 2 years, where we, for example, select a sample of transactions and then agree them back to supporting documentation, where we look at systems and controls and make sure that the correct systems and controls do exist, and the review of key areas. So, for example, looking at cut-off around the year end, and so, for example, with income, we might sort of look at income in the month before the year end and income the month after the year end, just to make sure that income has been accounted for in the correct period. So some of those traditional audit techniques have been around for many, many years, and as I said, it is fully possible to comply with the auditing standards completely just by using these traditional audit techniques. The difference between those and data analytics, as I've mentioned, is that with data analytics, you look at the whole of the data set, and therefore there are some additional things that can be done by looking at that whole data set. So things like, well, obviously if you look at the whole data set, that's going to be a far wider scope than traditional testing. For example, in an audit where we're picking a sample of transactions, we might pick a sample of, say, 20 or 30 and agree those back to supporting documentation. Obviously, when we're selecting that sample, we would hope that we select the sample with the best chance of identifying areas where errors might occur. But if you're looking at every single transaction or analysing every single transaction, then clearly you may well get a better result or find more useful information. Some of the data analytics tools can provide useful input into the quality of the accounting records, and later on in the webinar, James will look at that and look at some of the information that can be found about how good the accounting system is and how well the accounts are being maintained. As I've mentioned, it's more likely that the auditor will find unusual entries, and again, this covers a number of areas, and in a minute James will look at some examples of those sorts of unusual entries. Audit of difficult areas, things like related party transactions are very difficult for an auditor to identify, but by using keyword searches and searching the whole of the accounting data, areas like related parties can be audited much more easily, or it becomes much easier for the auditor to identify potential transactions. And finally, when looking at things like benchmarking and key performance indicators, if the auditor is sucking in all of the data and looking at all of the data when they're carrying out the audit, it makes it much easier for them to then benchmark the entity's results and help and use different KPIs to analyse those results and comment on the good and the bad and how that entity is doing. So that just in very summary level then, they're some of the key benefits of using data analytics. I'm now going to hand over to James, who's going to go into a bit more detail and look at some of those areas and actually provide some of the examples of what the output looks like.
Thank you, Alex. So firstly, I'm going to start by talking through some of the key areas where data analytics can widen the scope of traditional audit testing, but also add value. So Alex mentioned that data analytics differs from traditional audit work, such as substantive testing and analytical procedures. And this is because it can take complete data sets and trace through the transactions from initiation all the way to where they end up in the accounting records. And the software we use, Inflow, can do this almost instantaneously, and it can highlight whether there's any incomplete data, whether there's any accounts that have not been reconciled, any unusual transactions, all of which improves the quality of the audit and adds value in a number of different ways. Looking at the quality of accounting records and work patterns, what the data analytic tools can do is it can look at, or it can provide a valuable insight into how the accounting records are being used and the work patterns of certain members within the team. For example, how the users are using the software, the number of transactions that are being cancelled or recoded or corrected each period, what time of the day a lot of the transactions are being posted, and also which months the data is being posted into, as well as other trends and patterns that we can look at shortly. All of this can help management identify whether there are any issues with the quality of the accounting data and obviously the subsequent information that's being reported to management, and also whether there's any efficiency issues within the team. Obviously, if there's lots of duplicate postings or errors being corrected, it may identify wider issues. As well as the software can identify work patterns, so if people are working long hours in the evenings, weekends, around the reporting deadlines, all of this can be extracted from the data analytic tool Inflow and provided to management to make informed business decisions. Data analytics can also highlight large and unusual accounting entries, so it will search the data set and look for anything that's not within the course of normal business or material. And this can assist management and the auditors potentially identify fraudulent transactions, and then these can be investigated to understand whether they are reasonable and valid adjustments, or if not, why and how they occurred. And then fraud prevention methods and controls could be put in place, such as restricting access, deleting old users, and so on. Another area that Alex mentioned was in relation to related party transactions. This has historically been a difficult area to audit. What the software can do is you can key in keywords such as the related party, any related parties, and it can also extract information available at Companies House, run a search through the data, and pull out all related party transactions, whether they're sales, purchases, etc., all without the risk of human error. Now, this again can assist management with identifying the transactions. It may highlight transactions that management are not aware of, so that management can review these and confirm that they are valid, that they did know about them. And if they didn't, it can help the management and the auditors discuss the transactions and put in place fraud preventive and detective measures. So let's look at some illustrative examples. So here we have a graph and some data that is coming from our software Inflow. And this example on screen, what we've done, we have searched here for large and unusual transactions. So in the vertical axis is the occurrence, so how many times the transaction has gone through has occurred and gone through the data set, and the horizontal axis, is the impact on the profit. So if you look at the corners of on the left and the right, the top red corners of the graph, you'll see about 4 dots, which indicate that there were 4 large and unusual transactions that happened less than 3 times during the year that have had a material impact on profit. Now, the dots to the left indicate where there's been a reduction in profit, and the dots to the right where there's been an increase in profit. So what we can do here is we can look at these accounting entries, we can obtain a list, we can go and look at the underlying data and look at whether there was whether they were supported by supporting documentation, whether they were reasonable adjustments, and it could be for all kinds of reasons. We can make management aware of these, obtain the supporting evidence, and then feedback. The next example here, we have a number of different reports that has been produced again by Inflow, and what the various reports show from left to right. So if you go to the top left corner, this graph shows how users have used the accounting records and where entries have been posted into suspense accounts. The chart below on the left-hand side is the day of the week where the majority of the transactions into the suspense account has been posted. And on the bottom left-hand corner of the slide, we have the hour in which the postings were made. If we come across to the right-hand side of the slide, we have in the top corner, we have the month in which transactions were posted to the suspense account, followed by the document type below, whether it was a sales invoice, a purchase invoice, a credit note, or a journal posting. And in the bottom right corner, we have where the other side of the entry was posted to. Now, when we're looking at suspense accounts, typically these can give us an indication of the quality of the accounting records. Where we see high usage of the suspense account, it's where it can give rise to an additional risk from an audit and kind of reliable information purpose. So typically suspense account entries are made where management, or sorry, the users of the accounts are either trying to bypass the internal controls in place, whether they are data is incomplete in the system, so they're unsure of where the transactions have to be posted to. It can be an indicator of fraud, or perhaps where the accounts team are under time pressure, so they will post or could post transactions into suspense accounts with a view to correcting these at a later date. Now, obviously, high usage of the suspense accounts, depending on the reason for the usage, can give rise to concern. For example, if you look at the top right chart here, you'll see lots of postings around the June month. Now, if June was a quarter end, or if it was a kind of 6-month interim report, management could look at this and think, okay, there's lots of transactions that we don't know the full detail of going through around June, that could distort the financial information. And if we look at the next chart, this is where we've ran a search for entries that don't have a description in the field. So again, this type of report very much can give us an indication of the quality of the accounting. So if transactions are being posted with no description, it increases the risk of fraud or error, because management may not be aware of what the transaction relates to. There would clearly be additional time costs and time spent by not only just the auditors but also management in trying to identify what these transactions related to, why they occurred. And the software allows us to extract this information relatively easy at a few clicks of a button. Here we have obtained a report that has looked at the data set. So Alex mentioned earlier that the software can take the full set of data, run it through from start to finish, and then provide some feedback in terms of what's happened during the year. In this example, we've ran through the data has already been ingested by the software. It's reconciled the accounts to confirm that the data set is complete. And in this particular example, we're looking purely at the revenue cycle and the transaction flow. So here, what this chart shows is that of revenue of just shy of £3 million, 99.8% of the revenue has flowed through into, or of the transactions have flowed through into the revenue code, and 96.4% through into the receivables code. And of the data flow, the transactions have hit revenue, receivables, VAT, and cash, which is what we would expect. So here we can look at the anomalies in the data flow. So we can look at the 0.2% of the revenue that's not actually flowed through the revenue cycle, and then also the 3.6% that's not flown through into trade debtors. Now, in this particular example, what we identified was that a number of journals had been posted directly into the revenue code, which is why there was a difference of the 0.2%. And this was where management were making postings and adjustments to deferred and accrued income. Now, again, this was a valid and reasonable adjustment in the accounts, but it did highlight that actually the revenue per the accounts didn't stack up with the sales invoices raised. So it allowed us to look at that and provide some assurance to management that the revenue is actually being recorded correctly. In regards to the receivables, again, this was investigated, and what had happened is that a number of contras had been made by management against the debtor's ledger. And in this instance, management were unaware that that was happening within the business. There wasn't an internal control to review or authorise that. And although the adjustments were correct and reasonable, it did highlight that there was a potential control issue by not having a procedure in place. So here we could make recommendations to management to put controls in place to reduce the risk of fraud and or error. And looking at the benchmarking exercise that can be used. So here we have two images on the screen. On the left-hand side, we've got credit period, or some of you may know as debtor days. This is where the software has taken the data from the accounting records, calculated the debtor days or credit period of just under 90 days, and then compared it to the average of the sector. So in this instance, the credit period of the client was just under 90 days. The average was actually 52 days, which is shown by the top of the yellow bar, and the range of similar size companies in the sector was between 8.4 days and 244 days. So this can provide management with a good tool to compare how they are performing against their competitors. This can then be used by your auditors or your advisors to, one, I guess, provide you with the information, and then two, advise on how you could potentially improve your debtor days and what impact that could have on your cash flow. On the right-hand side, again, we've done a similar exercise. We've compared the number of reversals in the accounts, the sales code. So this is where orders are being returned, cancelled, or credited. And here we can see there's an average, which is the green bar on this image, of 3% in the sector of similar sized companies, but the company's current reversal rate was 6.2%. So it's far more than the industry average. Again, we can have discussions with the client in terms of why the variance is quite so large and how this can be reduced, and then management can go away and identify whether it's an issue with the goods and services that are being sold, or whether it's just an administrative issue with the accounting entries being posted. So just to summarise the kind of key benefits of data analytics, it's certainly a wider scope than traditional audit testing. It can provide a useful insight into the quality of accounting records. It can assist auditors and management identify large and unusual transactions. Again, it can assist auditors with the audit of more complex and difficult areas such as journals and related parties, and it can be used as a benchmarking tool to compare results against industry averages and norms. So I think that's it in terms of our webinar for the. We're going to now take questions and hopefully provide you with some answers. Before we do, we're just going to ask you, just going to go through another couple of poll questions. So the first question that hopefully is on the screen now, based on what you've heard today, do you think the use of data analytics would add value to your audit? So we're just waiting for the answers now. We don't seem to have had still collecting the responses as we speak. Okay, so it seems that those that have voted believe that using data analytics would certainly add value to their audit, and we'd like to ask a follow-on question. If would you be willing to pay a small premium for the use of data analytics during your audit? So hopefully the question is on the screen now, and we would appreciate if you could respond. Okay, thank you to those that have voted. So the feedback there is that for the majority of people, 65%, they wouldn't be willing to pay a premium for the use of data analytics, although 30% would. So thank you for answering those questions, those polls, and we're now going to answer some of the questions that have come up during the course of the webinar.
Okay, thank you very much, James. I think in terms of further summarising, one of the things that's relevant in terms of whether data analytics is used or not is that at the moment, the way the auditing rules are written, it's not possible for us just to use data analytics techniques. So when these techniques are used, it has to be used over and above some of the existing techniques and the existing methodologies which are used. So one of the key things is working out how it can be best used, and in terms of when it is used, the best clients and the best entities to use it on. So I think in terms of questions, we've got a few coming in there. So one of the first ones is, are there any cost advantages of using data analytics techniques? And really following on from what I just mentioned, I think that there can be. The problem at the moment is, as I mentioned, we can't not do some of the things that we've been doing all through my career and all through James's career. What we can do is use data analytics to further focus the audit, to really cut down on some of the work that is being used and being carried out. So in terms of cost advantages, it's probably not going to reduce the cost of an audit. It might make the focus of the audit better. The reason for asking the question about paying a premium is that often it does actually add to the length of the audit and add to the cost of the audit, because actually we're doing more and we're reporting on more than we previously have done. And therefore, in terms of cost advantages, certainly not going to go down, I don't think, certainly in the short term, until the accounting and auditing standards are updated to take account of the fact that some of these techniques are now available. In terms of other questions then, so there's another question that's come in about the actual use of data analytics and whether it can be used with all accounting systems. So I'll take that one as well, perhaps. I think the answer to that is yes, it can be, albeit that it's much easier to use data analytics and particularly systems like Inflow with certain systems. So some of the sort of well-known systems such as QuickBooks, Sage, Xero, for example, the import of data with those sort of well-known systems is much more straightforward. That's not to say it can't be used with other systems, and Inflow pride themselves, for example, on being able to import data from all systems, but it will be more difficult to do it if you've got an accounting system which is quite unusual. Having said that, as I mentioned at the start, it can be done. And sort of following on from that, there's another question about actually the process of using data analytics and how easy it is to do during the audit. I'll pass over to James perhaps to answer that one.
Yeah, so as Alex mentioned, there's typically two ways of getting the data into the system. So for the more standard accounting software packages, the software can either have a direct link into the software and extract all the data it requires, or a backup can be uploaded by the audit team or a member of the member of the client's team, or the alternative for more complex or bespoke accounting packages. The way that the data is ingested is by downloading various reports from the system, i.e. the client's accounting system, and then uploading the reports manually. And again, either can be done by the audit team or or sent through by the client's team. One other question that's just popped up is, do we see data analytics becoming a standalone service provided by accountants? So the answer to that is probably yes. I know that, and we know that a lot of the data analytics providers are looking at ways to add value to client data and widen the application of the use of data analytics so that it's a real-time, can be used as a real-time reporting tool, i.e. monthly, quarterly, etc., to extract key information that can be used by management.
And I think, just adding to that, I think what we might see is very much a situation where the more traditional year-end audit happens perhaps fairly traditionally, but then as a standalone exercise, various tools and techniques might be used as part of a separate process to look at benchmarking the quality of the accounting records, particularly if a company has had a fraud. We've actually used Inflow just to provide assurance that actually there's nothing else there that could be potentially fraudulent. So I think the answer to that is very much yes. Okay, so unfortunately we are now at the end of our time slot, so apologies if we haven't answered your question. Thank you very much for attending, and I hope you've found it interesting to find out a bit more about some of these new techniques that are available. Of course, if you do have more queries, then please either contact myself or James, or of course your usual contact at the firm, and do continue the discussion. I think it's one of these things which is new and evolving, so that there isn't a one-size-fits-all for all clients at the moment. So it's very much having a discussion with your contact and working out what's best for you as a client. This webinar will be available on our website, so if you want to watch some of it again, look at some of the outputs again, or indeed share it with a colleague, then it'll be available in the next few days. And as I said, thank you very much for attending, and I hope you enjoy the rest of your day.